So in terms of the motivation, I think half of my job was pretty much done when Anusha was presenting her paper. So because it's related to capital flows, volatility, capital controls, all of us are familiar in this room about these topics. So I'm just going to quickly go through it in the interest of time. So we know the emerging market economies have been witnessing increased volatility, especially in the last few years when capital flows collapsed during the global financial crisis, only to be revived in late 2009 and 2010. Thereafter, the inflows reversed again by the end of 2011 and 12, triggered by the sovereign debt rating downgrade of the US and the Eurozone debt crisis. So the sharp swings in volatility of flows has amplified the complexity of macro management of emerging market economies. While on one hand, capital inflows have benefits of providing additional investment financing, risk diversification opportunities. On the other hand, of course, uninterrupted flows could aggravate financial instability. So these increased volatility have forced the emerging market economies to undertake diverse capital account management measures in order to stem the flow of capital. So this is essentially the motivation of our paper, where we're not trying to prove any causality or look at any effect systematically or anything like that. It's more a descriptive or documentative analysis of what we see with respect to a few emerging Asian economies. So we focus on the evolution of capital flows in select few emerging Asian economies. What we do is we analyze the waves of flows experienced by these countries. So in particular, we look at the surge and the stop episodes of capital flows. And we also look at the changes in the composition of flows across these episodes. Then we describe some of the capital account management policies adopted by the recipient countries, which we have split in three different categories. One is the management of the impossible trinity or the financial trilemma in the face of rising and volatile capital inflows. The second is exchange rate management, and by this we mean intervention in the foreign exchange markets by the central banks. And third, of course, is the imposition of capital controls on inflows or relaxation of controls on the outflows. And as much as is feasible, we evaluate the efficacy of these measures by analyzing the impact on stock prices and exchange rates. But once again, this is work in progress, so your comments are most welcome. So this picture right here, it shows the volatility of capital inflows in Asia for 5 emerging Asian countries, namely India, Indonesia, South Korea, Malaysia, and Thailand, from right after the Asian financial crisis, that's the Q1 of 1998, running up to 2011 Q4. And of course, as we notice, is that from right after the end of 2006, volatility started increasing sharply, peaking around the time of the global financial crisis, and then it came down. And we measure volatility by calculating the standard deviation of quarterly gross capital inflows over the last 8 quarters, following Christine Forbes. So clearly, the gross capital inflows have been extremely volatile for these 5 emerging Asian economies in the recent years. So what we do is we use the Forbes-Warnock method. We were extending what they have done for a much larger sample of countries. We use the method to identify the periods of sharp changes in flows in either direction during 1995 and 2011. So for this, we go a little bit further. We even include the Asian financial crisis. So we're essentially looking at a gamut of more than 10, 15 years. So the way we are defining surge and stops, the details are of course given in the paper. So surge is a sharp increase and stop is a sharp decline in the gross inflows. We also superimpose these episodes with the evolution of gross inflows and outflows and net inflows as well. So what we find is that on average, there were 3 phases of surge experienced by these countries, notably pre-Asian financial crisis, right before the global financial crisis, and right after the GFC, before the Eurozone crisis. In terms of stops, all across these countries, the 2 most common stop episodes were the 2 crises of Asian financial crisis and the global financial crisis. There were, of course, country-specific divergences across episodes. For example, we find that India experienced the most number of surge episodes, numbering about 5, whereas Malaysia did not witness any. India and Thailand also witnessed the longest surge episode right before the global financial crisis, almost 7 quarters in length. And in terms of stop episode, we find Thailand experienced the longest stop episode during the Asian financial crisis. So this charts here pretty much confirm exactly what I've been saying. So if you look at India right here, all the orange bars that hopefully everyone can see are all the surge episodes. So all 5 surge episodes that India experienced even after the global financial crisis. Malaysia here doesn't experience any surge. When we look at the stops, the most common stops have always been around the global financial crisis and of course Asian financial crisis for the East Asian countries. So when we look at the composition of inflows around the surge and the stop episodes, we divide the capital flows into various categories. What we find is, for example, in India, for most of the surge episodes in the early 2000s, mid-90s, or right before the global financial crisis, it was driven by bank and non-bank flows, possibly because of interest rate differential or relaxation of borrowing norms. Whereas the later 2000 and some of the early 2000 surge was driven by portfolio equity flows. FDI peaked mostly during the pre-GFC surge. And this is also similar mostly across the other Asian countries that we look at as well. For example, even in Thailand, most of the surges were driven by bank, non-bank flows and portfolio equity flows. When we look at the stop episodes of the 2 crises, once again, the main channels of reversal of capital flows we find to be the bank and non-bank flows and portfolio equity. And this is a common theme across all the countries experiencing the stop episodes. We also find that FDI inflows remained fairly constant across both these crises. So moving on to the next part, what we do is, what are the different policy measures adopted by the authorities of these countries to counter the capital surges? And of course, it stems from the risks associated with such episodes, which has been widely documented in the literature already, and I'm not going to go over each of these. But as I said, we categorized it thinking that policymakers can resort to 3 broad macroeconomic measures to counter the surges. So the first is how do they deal with the impossible trinity or the macroeconomic trilemma. So the need to allow greater exchange rate flexibility in the face of rising capital inflows stems from the desire to retain monetary autonomy. And this, of course, is valid in the context of the trilemma that almost everyone in this audience is aware of. So what we do is we use the existing empirical methods so far in the literature that Eisenman, Chin, Ito started, and then I have done with Hutchison and Nirvikar, and then another paper with my existing current co-author, to describe these emerging Asian countries' experience with the trilemma over this entire sample period to see how it has evolved pre and post the global financial crisis. We split the sample period into 3 equal sub-periods, and we also examine the validity of the trilemma framework by testing how binding the trilemma is. So essentially, we test whether the sum of the 3 policy variables add up to a constant. And we also obtain the contribution of each policy variable by multiplying the estimated coefficients with the average of each indicator for each phase. So again, I'm not going to go into the details of all the method in the interest of time. So very quickly, when we look at the results, what we find is that, as expected and as is consistent with the literature, these 5 emerging Asian countries have negotiated the trilemma in a diverse manner, confronted with the rising and volatile capital inflows. So while none of them have adopted corner solutions, and we don't have China in our sample, all these 5 countries adopted an intermediate balanced approach. And the policymakers have accorded different weights to the policy objectives. For example, on one hand, India and Malaysia, in the most recent times, let's say from right before the global financial crisis to end of 2011, have significantly chosen to sacrifice exchange rate stability in the years to have greater monetary policy independence. But if you look at Indonesia and Thailand, for example, we find they have given much greater emphasis on managing the exchange rate at the cost of monetary policy. So there is a significant divergence across these countries. But when we look at Korea, it's fairly consistent, focusing on more monetary policy independence, followed by exchange rate stability across all the sub-periods. So there have been some divergences across these 5 countries in how they manage trilemma in the face of rising and volatile flows. And this is again reflecting what I just said. When we look at the contribution of each of the trilemma indicators, we find that this blue bar here is monetary independence and the orange is exchange rate stability. So, and this is the most recent period from end of 2008 to end of 2011. We find that for India, for example, monetary independence has gone up while exchange rate stability has been compromised to quite an extent compared to the earlier periods. India had significant exchange rate stability in early 2000s. Similar result in Malaysia as well, where we find monetary independence has gone up in recent times compared to the earlier periods. But if we look at Indonesia, and this is Thailand, for example, we find just the opposite. They have given more importance to exchange rate stability, that's the orange bar here as well, and much less importance to monetary independence. So across the countries, we find there have been a different emphasis accorded to these trilemma objectives when they are doing increasing capital account liberalization. And Korea, again, it's been mostly consistent across all the sub-periods, more importance to monetary independence, followed by exchange rate stability. And again, as Joshua also mentioned today morning, these are all evolving configurations as we speak. The second thing that we look at is while they are doing the trilemma management, to what extent are they intervening in the foreign exchange market to stabilize the currencies in the face of volatile capital flows? And a common tool for countering surges, of course, is sterilized intervention, which lets the countries experiencing the inflow surge to stabilize the currency and also insulate themselves from inflationary pressures, leading Reinhardt and Rogoff to say that this is a policy of the first recourse. So we find that all these 5 countries actively resorted to foreign exchange intervention. All the surge episodes are associated with significant reserve accumulation. For example, if you look at India, India built almost 80% of its end 2011 reserves during all the surge episodes. But when we look at the stop episodes, they are not universally associated with the reserve depletion. So this led us to question, and this is a trend that we find in our earlier research as well, that are these emerging Asian economies intervening in an asymmetric manner, intervening more actively during periods of appreciation and adopting a hands-off approach when it comes to depreciation. And we try to formally test this by using a central bank loss function following the method of Pontin's and Rajan and our own earlier work. Again, I'll skip all the model and the details in interest of time, but it's all there in the paper. So what we find is there is indeed strong and significant evidence that these 5 emerging Asian countries, the central banks have been pursuing asymmetric intervention in the foreign exchange market, at least during the sample period ending in 2011. To counter the surges and stops of capital flows. And also the sterilization attempts, they have continued for a few years, but the moment the sterilization started becoming costly, other measures were also taken recourse to, for example, raising commercial banks' reserve requirements to contain the domestic money supply. So this is something we saw in India and Korea, both the countries. Malaysia and Thailand have adopted similar measures when sterilized intervention started becoming costly. So there is evidence of asymmetric intervention during the sample period for these few countries that we look at. The third response of these economies that we are looking at, of course, is controls on inflows and outflows. And it's not surprising, of course, that during the 2000s, the entire phase, pre and post-crisis both, these 5 emerging Asian countries relaxed controls on inflows, perhaps to take advantage of the abundant global liquidity, and simultaneously also relaxed outflow controls to mitigate effects of inflows on the domestic financial markets. And this was done by all the 5 countries at different points of time. So to assess the impact of selected controls on exchange rate and stock market, we undertake a means comparison test. And this again is work in progress. There are, of course, different ways of evaluating the effectiveness. Means comparison test before and after the introduction of the controls. So we take 4 countries and a few specific capital control incidents to see what was the effect of these controls imposed. So for India, we take the imposition of restrictions in October 2007 on participatory notes to curb portfolio investment inflows. For Indonesia, we take the July 2010, that's after the global financial crisis, when the required holding period on foreign capital inflows was increased to 1 month. For Korea, we take the August 2007 government restriction on use of foreign borrowings for only manufacturing sector. And for Thailand, we take that famous unremunerated reserve requirement of 30% of December 2006, when a URR of 30% was imposed on all foreign transactions. So we selectively picked these few capital controls, and we just tried to look at what were the short and sort of medium-term effect of these on stock prices and exchange rate. So we look at focusing on periods covering 1 month and 6 months before and after the imposition of controls, and do a means comparison test of exchange rate appreciation and stock price increase. So what we find is that there is some weak evidence of the efficacy of these controls in controlling currency appreciation in India and South Korea, but we don't find any similar evidence for Indonesia and Thailand, for example, for their specific controls. And when we extend that window to 6 months, any effect completely disappears of pre and post control imposition. Similar results for stock price increase as well. There is no effect when we look at 6 months, and a very weak effect if we look at the immediate 1 month window. Also, we look at the effect of these controls on volume of gross inflows of capital, and we find that in some cases, for example, Thailand and Indonesia, there is a moderate success in lowering the volume, but not much success in the other cases. So this leads us to believe that the overall impact of capital controls ends up being a mixed bag. And this, of course, is consistent with some of the papers relevant in this literature. For example, Forbes and Warnock find that inflow controls do not affect capital surge episodes. Klein, for example, talks about a gate versus wall analogy where episodic controls identified as gates have a limited impact, whereas long-standing controls, which he calls walls, might have some effect. And also, recent paper by Yothin, Jinjarak, Huang, and others, they find very short-term effect of capital control. So this is quite consistent. Just looking at the 5 concentrated experience of the Asian countries, we find similar results as in the literature. We also look at what is the effect of the capital controls on the composition of liabilities, because the overarching thinking has been that capital controls, if anything, is able to alter the composition of liabilities. Dismantling of walls, we find that these countries have dismantled walls in a manner consistent with the pecking order, so to speak, of capital flows. Pecking order being the FDI is the least risky of investment flows, followed by portfolio equity, then local currency debt, and then foreign currency debt. And we find that most of these emerging Asian countries, the walls, likewise with the pecking order, the walls on FDI will liberalize the most, followed by equities, and debt continue to be restricted. In fact, in recent times, some of the restrictions on debt flows have been increased, as we know in a recent example in the Indian bond market as well, when restriction was imposed on foreign investors coming into the corporate bond market. So we find that sequential relaxation of controls do have an effect on impacting the liabilities composition, but that's about it. We don't find any systematic effect on either the prices or on the volume of the flows. So we also, this I'm just going to gloss over because we just do an analysis of the EMPI, and we look at the standard measures of exchange market pressure, a combination of exchange depreciation and loss of reserves, and we find that the EMP indices of all the 5 Asian countries display a symmetric trend around this entire time period. It goes up significantly during the global financial crisis, but otherwise, irrespective of whether they have played around with capital controls or not, EMPI doesn't show much of a divergent trend across these countries, so largely significant, but again, this is a work in progress. What we were attempting to do with this study is to kind of contribute to the debate going on in the global policy circles right now, but what are the measures adopted by countries to deal with volatile capital flow, since volatility has not gone away anywhere. And we find that countries have resorted to multiple ways of dealing with capital flows, which are reflected in changing configurations of the trilemma. Asymmetric foreign exchange interventions may or may not be sterilized, and or capital controls. And with capital controls, we find that ad hoc controls in response to surge or stops are not as effective, but perhaps a longer term approach towards capital account management might be necessary if countries at all want to go that way. Alternatively, of course, a much longer term route is developing domestic financial markets and banking institutions so that when you face the volatile inflows, you're able to absorb it much better instead of imposing these controls on an ad hoc basis. That's all. Thank you.
So I've learned very much from this study, but I would just focus my comments on 3 issues. the evolution of the capital flows, analysis of trilemma configurations, as well as the effectiveness of capital flows measures. We start with the evolution of capital flows. In consideration of data availability, the sample period that was being used in this study from 95 quarter 1 to 2011 quarter 4 is considered to be very long already. As mentioned by Raj, this already allows for very interesting comparisons between Asian financial crisis and global financial crisis. However, as mentioned by the earlier speakers this morning, some major events related to capital flows have happened more recently, whether it's the QE2 or 3, QE in Japan, or more importantly, Fed's QE tapering announcement, as well as the commencement. So it'll be very interesting to see how capital flows patterns are affected by these events. Okay, so we also saw a good presentation on the surge and stop episodes of capital inflows to these 5 countries. And this is really useful because we can then focus our attention on the relevant time periods, and it also facilitates comparisons across the countries for these relevant time periods. But I think to have a fuller picture, perhaps the paper can also include flights and retrenchment episodes. These would be associated with the sharp increase and sharp decreases in outflows. Now, apart from waves in capital outflows, I think composition of capital outflows are important as well, because the country experiencing massive capital inflows will have a stock of gross external liabilities potentially at risk of reversal. So when there's a sudden capital outflow, it's uncertain whether the country is able to remit its gross external assets back quickly. So to assess this risk, it may be useful for us to look at what's the composition of capital outflows in the individual countries as well. So these are broad comments on the patterns of capital flows. I will now turn to more specific comments on the analysis of trilemma configurations. The policy trilemma is, of course, a very important issue for Asian countries, not least because our financial systems are small and exchange rate stability is very crucial for our economic growth. So, as explained by Raj, the countries have opted for intermediate measures, which means limited monetary policy autonomy, a managed float exchange rate regime, and partial capital controls. Now, this gives rise to different trilemma configurations across the countries. And Professor Eisenman and his co-authors have developed a set of trilemma indexes. The indexes take values from 0 to 1. Higher value means the relevant policy goal has been achieved to a greater extent. So this Eisenman-Chin-Ito trilemma indexes differs from the indexes used in the paper by Raj. First, Raj's paper used the de facto index for financial openness, which is based on net capital flows, whereas for the Eisenman-Chin-Ito index, a de jure index is used, which is based on the country's reported restrictions. Another difference is in the exchange stability index, and that one in the Eisenman-Chin-Ito index, we have the standard deviations of the exchange rate between a country and its base country, whereas Raj's paper has the goodness of fit measure from the Frankel-Way regressions. I think the monetary independence index is the same for both papers. So we trace the Eisenman-Chin-Ito indexes for the 5 countries, and for India, we see that the capital flows, the financial openness index remained low throughout the period. That's the green line, whereas the blue line is the exchange stability index. It came down while the monetary independence index went up. So this is consistent with what Raj was saying. For Indonesia, the financial openness index remained high until the post-crisis period when they started to implement capital flows measures. The rupiah was quite stable until the global financial crisis when it experienced great volatility. For Korea, that is the only country where the financial openness index went up post-crisis, and this is consistent with their aim to become an international financial center. The won was subjected to great volatility as well post-crisis. Like Indonesia, both Malaysia and Thailand imposed capital flows measures after the crisis. So the green line financial openness index dropped in the crisis period. The plunge in the blue line for Malaysia is reflective of the ringgit exiting from the US dollar peg. So what is strange is the monetary independence index went up for quite a few countries. So the red line went up for Malaysia, for Thailand, also for Korea. And when we plot these indexes for Hong Kong, the monetary independence index went up as well. So this is a strange result. So as mentioned, so the monetary independence index is based on the correlations in interest rates between the country and the US. So in the post-crisis period, US interest rate was basically zero. So what this means is the short-run correlation between the US and other countries will be lowered, since the US interest rate is not moving at all. So this in turn translates to a higher monetary independence index. I think this was actually mentioned in the Eisenman Chin Ito paper. So care has to be taken when we use this index in the analysis for post-crisis period. On the financial openness index, to the extent that we want to gauge policy responses, it may be better to look at the de jure index instead of de facto index. However, if one should decide to use the de facto measure, I think that the net capital flows may not be so reflective of financial openness, because large inflows can be negated by large outflows. So perhaps an alternative is to use the sum of total asset and total liabilities normalized as a ratio of GDP. In Hiro and Professor Kawai's paper, they wanted to distinguish between official investment from private investment, and so they abstracted the official reserve assets from the sum. The final comment on trilemma analysis is that is regarding the test on whether the trilemma is binding. So this equation was used in the paper. I think there may be a difficulty using a constant term as the dependent variable. I think we have to be very careful what the error term mu t, what the properties are, because that would influence the validity of the inference that we get regarding the coefficients alpha, beta, and gamma, which was being used in the paper. So I suppose to test if the trilemma is binding, one way is just to take the sum and then see how the sum evolve over time around the number 2. So my last set of comments is on the effectiveness of capital flow measures. So the paper provides a very good summary of the capital flows measures adopted by these 5 countries, and it formally assesses their impact. So they found that the capital flows have actually limited success in restricting capital exchange rate appreciation and stock price increases. At the same time, the paper also says that liberalizing capital restrictions in a sequential manner from less risky flows to more risky flows will influence the composition of capital inflows towards the longer term flows. So even if we can't find very much success in the limits to exchange rate appreciation of stock prices, I think that because the composition affects the degree of volatility of in the overall flows, by just shifting this composition, the risk of sudden stop is already being reduced. So I would actually consider that as being effective. The Asian economies are making greater use of macroprudential policies, and the paper by Chang and Jolie and some others found that these macroprudential policies are actually effective in leaning against equity flows, credit growth, bank leverage, and house price increases. So if the macroprudential policies are able to safeguard the financial stability of a country, then over the longer term, this will of course help the macro performance of the country. So in that sense, these kind of measures are also very effective. So I also agree with the speaker this morning, I think it was Ila, who talked about capital flows measures unilaterally being taken by one economy actually affects other economies. So there's actually a lot of scope for regional coordination of capital flow measures across countries in order to reduce the policy spillovers. Thank you.